Hello. Today's world economic news, starting with from the Financial Times, little charts showing news flow from the media about the economy and whether they're positive stories or negative stories. And you can see top left there is the United States, and since the middle of 09, nearly 2 years, mostly positive stories. In Japan, very, very similar, mostly positive stories. Down below, the bigger one, a very similar picture in the United Kingdom, mostly positive stories for nearly 2 years. And as the Financial Times says, and look, good UK news flow has gone up recently through zero economic growth, stagnation and misery, etc. It is a bit odd. And they throw in, we're confused. On the other hand, look out below in China and India, where you can see it rose earlier in 09 and peaked and is now coming down in China and India. Does it mean they're more honest, or there actually is more negative economic news in China and India? Perhaps we'll never know, because we can't trust the bastards. Moving on to the Business Spectator. In Australia, stagflation nation, the home of hopeless housing. Now this is new, isn't it? It was boom, boom, boom ever since I've been doing these economic videos in Australia for housing. It was new. It was a whole new paradigm. Rather than fall suddenly, Australian property prices could stagnate. This is what you normally get at the start of a bust, isn't it? Oh, stagnation, at best, worst, stagnation, for an extended period. That's just hope, isn't it, really? Or slowly deflate over time. Just a little, might go down a little over a long time. The big question is, how will investors react to the prospect of dismal market returns? I don't know where that sentence comes in. Investors and prospect of dismal market returns. They're talking about property. Still, Australian housing boom is big news. I think that only leaves parts of Canada. Oh no, there's Hong Kong and China still booming. Well, Hong Kong anyway. Maybe Singapore. Moving on. Google sells $3 billion worth of bonds in a home-run debut offering. Why Google, which is absolutely stuffed to the gills with cash, is selling bonds? The best reason I've found is that they're stuffed to the gills with cash, but not in the United States, because they haven't repatriated or patriated the money. It's around the world, staying out of America, so they don't have to pay tax on it. But they want that $3 billion for something. So they're just borrowing new money in America and leaving the foreign profits foreign. Felix Salmon, the big and little mortgage fraud news. This is a big story, and unless you're following it, you're not too late to catch up. But it's about the banks and how they were doing their fraud things in these mortgages. What can I say? They've kind of agreed to about 25 billion payment to get the attorneys general off their backs, and now they're stalling for time, because it looks like it could well be that the attorneys general and other agencies and other courts can push for maybe 80-90 billion from the banks, in payment for being naughty. But the longer it drags on, the cheaper it'll probably be for the banks, and they're making it drag on as long as possible. This is Financial Times' Martin Wolf talking about Dominic Strauss-Kahn. And if you look along the bottom, he says Mr. Strauss-Kahn's downfall happens to come at an important moment. But that just happened to be tacked on at the bottom of these charts, which are just a repeat of things I've put up before. But it is an important moment for the Eurozone, because the Eurozone bailouts are EU and IMF joint ventures. Interesting top left of the chart. For exports being more than imports, type countries, exports more than imports, the Netherlands, Holland and Germany right up there. They export a lot more than they import. Doing a bit more exporting than importing are Finland, Austria and Belgium. Belgium pumping out the chocolates or whatever. Italy and France do a bit more importing than exporting. And then you've got the bad ones, Ireland, Spain, Portugal and Greece, that do a lot more importing than exporting. But as we said yesterday and the day before, Spain and Greece are trying to get those imports down, or at least those imports are coming down because they can't afford to import anymore. But more importantly, along the bottom are banking sector exposures to these sovereign nations. Along the top, the bottom left is to Greece, Ireland and Portugal, and on the right it's to Spain, and Germany is far out in the lead on both, with France below. Germany has been saving a lot of money over the last 10 years, and their financial sector has been lending it to Greece, Ireland, Portugal and Spain. Financial Times again, Spain's peripheral problems, 26.5 billion euros of hidden debt, ? Different ways of looking at this, but basically they've got local elections coming up, and there's a lot of autonomy in the local areas in Spain. The local areas can borrow and spend a lot of money, and they have been doing so, and they're having elections, and what they are saying here is that the incumbents are keeping the accounts looking good while the election is on, but after the election, whoever gets voted in is quite liable to open the books up and make it as bad as possible at the start of their new reign as incumbents, which could make all the debts go wildly up when all of the new incumbents open the books up, including this 26.4 billion which has been borrowed by companies owned by the regions, and that 26.4 billion is off balance sheet because it isn't been directly borrowed by the regions but by companies owned by the regions. It's tricky, it's deep and tricky and dirty and murky. Beyond BRICS, quite interesting, Brazil. Job figures raise red flags. If you've tried to cross the road anywhere in central Sao Paulo over the past few days, you may have come across a very bored man with a flag. As part of a safety campaign, the government has employed people to stand by the side of the road all day, holding up signs to tell the pedestrians waiting next to them that they must indeed wait for the green man before crossing. Seemingly superfluous jobs like these are all too common in Brazil. You can get the idea what's going on. And later in the article I've pulled out this, which is very odd. By this logic, and you've got to read the article to see what the logic is, but you can imagine, Tuesday's payroll data was good. Brazil's economy added 275,000 jobs last month, which was fewer than the figure that was proposed, which was 350,000. In other words, they've put on less jobs than was expected. And that's good, because all these people being employed is pushing up inflation because they've got too much money to spend. It's different in different parts of the world. It's balanced and very tricky. And to finish with another video to watch, it's a more direct link this time. It's the same outfit, it's short view, Financial Times, and the video is called Britain's Inflation Problem. But it is pertinent to US inflation problem as well. It's basically the same deal that goes on, but because it's done in English for the UK, more Brits would be interested. It sums up a couple of the concepts that I've been pushing this week. Leave it with you. See you tomorrow. Bye.